Welcome, guys. We are going to start on chapter 10 this week. So we're talking about stockholders' equity. And we're going to learn a lot about dividends. We're going to talk about splits and treasury stock. So we're going to learn a lot here. Let me get rid of this. How do I get rid of this side? Okay, that's what I want. Okay, any questions before we start? Is everyone good? So there's a lot we're going to cover today. And you already know some aspects of stockholders' equity because we've talked about the statement of stockholders' equity. And we know that there is paid-in capital, which is basically outside contributors purchasing stock. We call it common stock. We're going to change it to paid-in capital right now. Retained earnings is another section of stockholders' equity where we deal with earnings or equity that's been created within the company. Net income each year minus the dividends that we've paid are a part of retained earnings since the beginning of time, beginning of inception of the company. And treasury stock is something new we're going to talk about. And it's basically when the company buys back shares out in the public. So paid-in capital is the amount stockholders have invested in the company. Retained earnings, the amount of earnings the corporation has retained. And then treasury stock is the corporation's own stock that it has reacquired. So here, if you look at the American Eagle Outfitters, you'll see here, a balance sheet. And on this balance sheet, you'll see how it's broken down between various types of stock, which we call total paid-in capital. And then you'll see retained earnings. And then you'll see less treasury stock. And the less treasury stock, that is stock that the company has purchased back from outside ownership. And there's different reasons we'll do it, and we'll talk about it in a minute. So there's different ways that corporations can get the cash they need to expand or advance. One way is by issuing stock. When they issue stock in a company and the company acts as a corporate entity, there are mainly a lot of benefits with acting as a corporate entity. There's some disadvantages we'll talk about, but there are a ton of advantages. Generally speaking, most corporations follow this organizational chart. What this means is the stockholders, when they purchase shares of a company, they are the ones that own the company. The stockholders elect a board of directors. So among all the stockholders, they vote on a board of directors. And it's the board of directors who elects the CEO or appoints the CEO, the chief executive officer, the main head honcho. And the CEO then determines who he wants as his management group. It's important to know the board of directors are voted and elected by the stockholders who own the company. The stockholders don't run the company. They elect others to run the company. Okay? Ultimately, the corporation's stockholders do control the company because they have the right to vote and elect who's going to run the company. When a corporation begins, they first raise money however they can from those within their sphere. And then as companies grow, they'll try to seek monies from various sources, angel investors, venture capital firms, and IPOs. The IPO is called an initial public offering, the first time that the company issues stock to the public. Now, to get to that place, there's a lot of work that has to be done. That initial IPO is what really allows the company to gain the capital they need to do expansion. So, you see, initially companies begin, they grow, they need more money to grow bigger, which is why they end up going public and issuing shares to the public. Now, there are public corporations and there are private corporations. Public corporations have a lot more regulations to adhere to with the Securities and Exchange Commission. But by having that, they can allow anybody in the public to invest with them or to purchase their stock. And as a result, can end up with a lot more stockholders. Walmart, Microsoft, Target, lots of companies that we're aware of are public. Private companies don't have public investments, aren't regulated by the Securities Exchange Commission, and as a result have smaller, fewer stockholders. But there's a lot of companies that are private and still well known. Cargill, Coke Refinery, Mars Food Company. So, no, the main difference is a result of are they public? Means they're regulated by the Securities and Exchange Commission. If they're private, they have a lot more flexibility and leeway, but they also don't have means to gain as many shareholders. Now, shareholders have certain rights. As we talked about earlier, they have the right to vote. They can vote on who to elect as board of directors. They have the right to receive dividends. And they have the right to share in the distribution of assets in the event that the company would be dissolved. Some advantages of the corporation, and they're huge advantages. Limited liability is very significant. The stockholder can't lose any more than what they've invested in the company. And as we said earlier, the ability to raise capital. And you can transfer ownership fairly easily by just selling your stock. Disadvantages, there's a higher tax related to corporations because at the corporate level, they have to pay taxes. And then when they pay dividends to the shareholders also have to pay taxes on that money they receive. Although recently things have changed a little, they're trying to make the tax laws are making it a little more favorable, but it's still the case. Lots of paperwork involved with the corporation. So guys, I'm going to give you this question. Which of the following is a primary advantage of forming a corporation? Reduced taxes, increased personal liability of the owners, increased ability to raise capital and transfer ownership, or D, fewer state and federal reporting requirements. What do you think there? I must have just given it to you. You see here, the increased ability to raise capital and transfer ownership. It's not reduced taxes, it's greater taxes. It's not increased personal liability, it's decreased personal liability of the owners. And there's more state and federal reporting requirements. So now we're going to talk about how we go about and the journal entries to issue common stock. No. Stock can be authorized, which happens at the start of the entity's formation. It can be issued and outstanding. So, no. Authorized stock is what's available to sell. And that authorized stock can be issued and unissued. It's the entire amount of stock that is allowed to be sold for the corporation. This is determined at the onset. Issued stock are those shares that are actually sold. Those are shares that are out in the public and also shares that the company has purchased back from the public. Outstanding shares are just those shares that are held by investors. So no, there are 3 different definitions as we talk about stock. There are some more definitions. Par value. And this is a term that can be confused by people. Par value is just called the legal capital per share of stock that's assigned when the corporation is first established. It has absolutely nothing to do with market value. Some students think par value is synonymous with market value. No. Par value is the legal capital per share that is set when the corporation is first established and is unrelated to any type of market value. Market value is what the current share price is, what it's worth, what it's selling for. Usually par value is nil, small. But if there's a par value stock or a no par stock, we record it differently. So in this example, Canadian Falcon issues 1,000 shares of no par common stock at $30 per share. When stock is treated as no par, we debit the cash and we credit common stock for the full amount. Now, it's a little different when we have par value. When we have par value, we break down the amount of par value to the amount of additional paid-in capital. We still debit our cash, but with common stock, we'll only take those 1,000 shares times the amount of par value. So if we have 1,000 shares at 1 cent par value, we credit common stock at $10. And the difference we apply to additional paid-in capital, $29,990. Both of these are still stockholders' equity accounts, but we just do it a little different when we have par value versus no par value. So guys, I'm going to give you a minute on this. Company A issues 20,000 shares of $5 par stock at $12.50 per share. The entry to record the issuance would include which of the following? A debit to cash of 100,000. B, a credit to common stock of 250,000. C, a credit to additional paid-in capital of 150,000. And D, credit to additional paid-in capital of 250,000. I want you to think this through, and I want to see your answer in the chat. Okay? Let me see. Well, I gave you the answer. How are we going to do this? We're going to debit our cash for 20,000 shares times 1250. We're going to credit just for the par value, 20,000 shares times $5 a share, 100,000. And then we're going to credit the difference to additional paid-in capital of 150,000. Do you guys understand that? Does that make sense? Yes, no? Now, we also have common stock, which we're familiar with. But then we also have what's called preferred stock. And it's another type of stock. It's not as common, but we're going to talk about that right now. So with common stock, that's what most people are familiar with. Preferred stock is a little bit of a mix between a note and stock, and we'll talk about that. So when we've got preferred stock, you don't usually vote with preferred stock. It's not as risky as common stock, but the risk isn't as great, but neither is the reward. The reward isn't as great. It's a kind of hybrid, I guess is the best way to say it, between common stock and bonds. Know that if there's preferred stock, they receive dividends prior to the common shareholders. And this stock isn't as risky as common stock can be. So sometimes with preferred stock, they can have convertible shares where they can be converted to common stock or redeemed by the corporation. And this is an interesting feature called cumulative. The cumulative aspect means that if a company doesn't pay dividends in a particular year, then those dividends are accumulated and are allowed to be paid in future years. And we'll go through some examples of that. So again, here you see a balance sheet, the stockholders' equity section of a balance sheet showing the breakdown when there's preferred stock and along with common stock par value. Okay. Remember, preferred stock has features of both common stock and bonds and is usually included in stockholders' equity. Some preferred stock is so similar to bonds that some companies include it in bonds payable. But for our purposes, guys, it's going to be equity. Okay, so here's the first exercise we have. Nathan's Athletic Apparel has 2,000 shares of 5%, $100 par value preferred stock. The company issued at the beginning of 2017. All remaining shares are common stock. The company was not able to pay dividends in 2017, but plans to pay dividends of $22,000 in 2018. Assuming the preferred stock is cumulative, how much of the $22,000 dividend will be paid to preferred stockholders and how much will be paid to common stockholders in 2018? So you first look at the dividends that should have been paid to the preferred shareholders in 17 but weren't, which is 10,000. Then you look at what should be paid in 18. 2,000 shares at 5% times $100 par value, another 10,000. So if the company is paying $22,000 in dividends, 20 of them are going to be paid to the preferred shareholders, and the difference, the 2,000, will be paid to the common shareholders. Okay? If the shares are called non-cumulative, that means they don't accumulate. If the company didn't pay dividends, they're out. Nobody's going to get paid dividends. So in non-cumulative shares, for 2018. The dividends here for 17 are 0 because it's non-cumulative. They're not going to receive them. For 18, they're 10,000. And then the rest goes to the common shareholders to total up to the 22,000. Does that make sense, guys? Do you have any questions on that at all? Okay, guys, let's look at this one. Which of the following is a primary advantage of owning preferred stock? I'm going to let you guys put it in the chat. Ian says A, Brendan says C. Who else, guys? There's a couple more of you guys out there. So, preference over common stockholders in the distribution of assets in the event of dissolution. Okay. Now we're going to talk about treasury stock. The corporation's own stock, it's reacquired. Companies sometimes do this because they might have excess cash, and instead of paying dividends, they need to do something with that cash. Or they can reduce the number of shares outstanding, which basically can assist in upping the price of a stock that might be underpriced. They'll boost the earnings per share because there's not as many shares outstanding. And then oftentimes, to satisfy employee stock ownership plans, they need to retrieve some stock for that purposes. No, students can confuse the purchase of treasury stock with investments in another company. An equity investment is the purchase of stock in another corporation, which is an increase in assets. Treasury stock is the repurchase of a corporation's own stock. And when we do that, it's a reduction in stockholders' equity. We will reduce stockholders' equity when we purchase stock. It's not an asset. Companies can't invest in themselves. So when a company purchases treasury stock, we would debit treasury stock and we credit our cash. And this treasury stock is kind of like a contra account in the stockholders' equity section. It reduces stockholders' equity. So you see this example of a company prior to purchasing treasury stock, and then a company after purchasing treasury stock. The stockholders' equity section gets reduced by the amount of that treasury stock. So once we purchased treasury stock, and then let's say we reissue it. If we reissue treasury stock for higher than what we purchased it for, we purchased it for 30, but let's say in this example, we reissue it for 35. Then in that case, we're going to debit our cash. We will credit the treasury stock for the amount we initially purchased it for. And any difference will go into additional paid-in capital, either way. In this case, because we purchased it or reissued it for more than what we purchased it for, we credit additional paid-in capital. This increases our stockholders' equity, and it shows that we made money on our treasury stock. So after reissuing it, you see how our stockholders' equity has increased. So what happens now if we reissue treasury stock below what we purchased it? So we initially purchased it for 30. But this example shows that we reissued it for 25, under what we had initially purchased it for. So we're going to show our cash. We need to zero out the treasury stock. We need to zero out what we purchased it for. In this case, 30 bucks. And the difference is going to be a debit to additional paid-in capital, which basically shows a loss. It shows here a loss on the stock. Okay. The key here is the stockholders' equity section will show treasury stock, and that treasury stock will be treated as a contra account. When we purchase treasury stock, it reduces our stockholders' equity. But then when we reissue treasury stock, the difference between what we had purchased it for and what we're reissuing it for is going to either go into additional capital, paid-in capital, either as a debit or credit, depending if we made money or if we lost money. But the key is we have to zero out the treasury stock, what we initially purchased it for. So guys, this exercise, 10-6, finishing touches has two classes of stock, 8%, $10 par preferred, and $1 par value common. Following transactions affect stockholders' equity during 2018, its first year of operations. January 2nd, issues 100,000 shares of common stock for $35 per share. February 6th, issues 3,000 shares of 8% preferred stock at $11 per share. September 10th, repurchases 11,000 shares of its own common stock for $40 per share. And December 15th, reissues 5,500 shares of treasury stock at $45 per share. I'm going to give you a couple minutes and I want you to attempt this on your own. Okay? Let me know. Give you a couple minutes here. How you guys doing? Okay. So the first journal entry will be a debit to our cash for the full amount. We'll do a credit to common stock for the par value, and we credit additional paid-in capital for the difference. Okay. Then, for the February 6th journal entry, we debit our cash for the full amount. We credit our preferred stock for the par value, and again, we credit additional paid-in capital for the difference. When we purchase our treasury stock, we debit treasury stock for the entire amount, and we credit cash. Then, when we reissue treasury stock, some of it, 5,500 shares of it, we debit our cash, we credit our treasury stock for the amount we purchased it for, $40 a share. 5,500 shares we're reissuing at $40 a share. And that extra $5 we reissued it for gets credited to additional paid-in capital. Okay? Treasury stock has a normal credit balance, decreases stockholders' equity, is recorded as an investment, or increases stockholders' equity. We know it's got a debit balance. We know it is absolutely not an investment. And we know it does not increase stockholders' equity. Therefore, it does decrease stockholders' equity when we purchase treasury stock. So earned capital would be retained earnings. The income we receive every year minus what we pay out in dividends. So earnings that stay in the company and that don't get paid out in dividends would equal the retained earnings. It has a normal credit balance. If it has a debit balance, that means the company is in trouble because that means they have losses. So in year one, if they lose 1,000, their balance in retained earnings is a debit of $1,000. Then in year two, say they earned 3,000, but they didn't pay out any dividends. If you take that, you take the 3,000 and you offset it with the negative 1,000 in year one, you end up with a balance of 2,000. And then in year three, if the net income in year three is 4,000, they paid out dividends of 1,000, that nets 3. And if we show a balance in year two of 2,000, that 2,000 beginning balance plus the 4,000 of income minus the 1,000 of dividends gives us a balance in retained earnings of 5,000. In year four, we start with 5,000 The net income is 10. We have dividends of 3. So our 5 plus our 10 minus our 3 would show a balance of retained earnings at the end of the year of $12,000. Remember, it's an accumulation. All net income minus all dividends over the life of the company. Cash dividends are what we're familiar with when we hear about companies paying out dividends. They're distributions by a corporation to their shareholders. Usually they happen quarterly or annually. But not every company will pay dividends. Many growth companies do not pay dividends. They need that money to reinvest in the company. So there are a couple of dates when we talk about dividends. There's a declaration date, a record date, and a payment date. In 2 of these dates, we will report journal entries. So the declaration date is when the board says they're going to pay dividends. The record date is the date of record when those dividends will be paid, and then the payment date is when they are actually being paid. On March 15th, Canadian Falcon declares a 25-cent per share dividend on its 2,000 outstanding shares. It's at that time we debit our dividends and we credit what we call dividends payable. Okay. Then when the dividends are declared, they say they're going to be paid on April 15th. The record date we don't do anything with. We show then our dividends payable is debited and we credit our cash for the full amount. Okay? Does that make sense? Remember, the declaration of cash dividends decreases retained earnings and increases dividends payable. The payment of cash dividends decreases dividends payable and decreases cash. The net effect then is a reduction to both retained earnings and cash. Here, we're going to look at these various transactions and record them. Italian Stallion has the following transactions during the year. On February 1st, issues 6,000 shares of no par common stock for $16 a share. Since it's no par, we just put the whole amount to common stock. Next one. On May 15th, we issue 700 shares of $10 par value preferred stock for $13 a share. Here it has a par value. So we separate. We debit our cash. For 9,100, we credit our preferred stock for the par value. And then we credit additional paid capital for the difference. Next, October 1st, declare a cash dividend of $1.25 per share to all stockholders on record. So we have 6,000 common stockholders, 700 preferred stockholders. So 6,700 shares at $1.25. We debit our dividends and we credit dividends payable. The date of record, we do nothing. Then October 31st, when we pay the dividend, it's at that time that we will show a debit to dividends payable and a credit to cash. Okay. So now we're going to talk about the difference between dividends, stock dividends, and stock splits. Stock dividends is when a company gives additional shares of a company's own stock as dividends. Whereas a stock split is a large stock dividend that includes a reduction in the par or stated value per share. So if you have a 10% stock dividend, you get 10 additional shares. A 20% stock dividend, you get 20%, 20 additional shares. And 100% stock dividend, you get 100 additional shares. The 10 and 20% stock dividends are small stock dividends. 100% would be a large stock dividend or a split. When we have a split, you don't need to record any transactions. All it does is reduce par value per share. Large stock dividends, we do something. We record a decrease in retained earnings as an increase in common stock, since we record that at par value. So no, with a stock split, we don't record anything. The par value just gets decreased. With a stock dividend, the overall stockholders' equity amount doesn't change, but the common stock will increase, the retained earnings will decrease. That's it. We're just taking from one to put into another. Think of a stock split or dividend. You've got one pizza. You got one pizza. You can cut it into 2 pieces or you can cut it into 20 pieces, but it's just one pizza. You might have more pieces of pizza and they're smaller pieces. So it sounds like I ate 20 pieces of pizza, but it's just proportionately less. So this exercise is going to show September 1st, the Board of Directors of Colorado Outfitters declares a stock dividend on its $10,001 par common shares. Market price of the common stock is $30 on this date. We'll treat it. If we'll assume it's a 10% stock dividend, then we'll treat it as 100% stock dividend. Okay? And then a 2-for-1 stock split. So a 10%, we would debit stock dividends and we would credit common stock. So we're basically taking it out of retained earnings and transferring it into common stock if the stockholders' equity totals don't change. So we debit stock dividends for the full amount. We credit our common stock for the par value, and we credit the difference for additional paid in capital. If we treat it as 100% stock dividend, we debit our dividends, we credit our common stock for $1. And if we do a stock split, there's nothing we do. Just the par value will change. So in this example, the company has 1,000 shares of $20 par stock outstanding and issues a 2-for-1 split. How many are outstanding after the split? 2,000. We started with 1,000. If we're giving an additional share for every one we have, then we'll end up with 2,000. So the stockholders' equity section shows at a point in time a snapshot of where we sit. The statement of stockholders' equity gives us the detail of what happens throughout the year. We start with our beginning balances and we show what happens with any issuances, any purchasing treasury stock, selling treasury stock, and dividends along with net income. Breaks it down. The balance sheet always is a snapshot. The statement of stockholders' equity gives us the detail. How are you guys doing so far? How's it going? Good. Good. Okay. United Apparel has the following balances in its stockholders' equity accounts on December 31st. Treasury stock, is 850,000. The common stock is 600,000. Preferred stock, 3,600,000. Retained earnings, 2,200,000. Additional paid in capital, 8,800,000. Prepare the stockholders' equity section of the balance sheet for United Apparel. So you'll see, we show our preferred stock first, then our common stock, just the par value. We show our additional paid in capital to then come up with our total paid in capital. Then, here. Then we show our retained earnings minus our treasury stock to come up with our total stockholders' equity. So this next section, ratios, I'm going to let you guys look at on your own. We're done for this chapter. Any questions before we end? Well, guys, have a wonderful day.
Thanks.
Bye, guys.